So, what is CAPM? The Capital Asset Pricing Model, or CAPM, is a model used to calculate the expected rate of return for an investment. It is one of the most widely used models for investors and is often considered the industry standard. The model takes into account the amount of risk that an investment has and compares it to the amount of return that an investor could have earned by investing in a risk-free asset such as a government bond. The difference between the two is the amount of compensation an investor should receive for taking on additional risk. The formula for the capital asset pricing model is as follows. Expected return equals risk-free rate of return plus beta times the difference between the market return and the risk-free rate of return. Let's break down this formula and see how it works. The expected return is simply the amount an investor expects to make on their investment. The risk-free rate of return is the amount an investor could earn with a risk-free investment, such as a government bond. Beta is a measure of a stock's volatility in relation to the overall market. If a stock's beta is 1, it moves in the same direction and at the same rate as the overall market. If a stock's beta is greater than 1, it is more volatile than the overall market. And if a stock's beta is less than 1, it is less volatile than the overall market. The market return is the return that an investor could have earned by investing in a broad market index fund. Let's do an example together. Let's say that you are considering investing in a stock that has a beta of 1.2. The risk-free rate of return is 5% and the expected market return is 8%. Using the CAPM formula, we can calculate the expected return for this stock. Expected return equals 5% plus 1.2 times the difference between 8% and 5%. Expected return equals 5% plus 1.2 times 3%. Expected return equals 5% plus 3.6%. Expected return equals 8.6%. Why does CAPM matter? The capital asset pricing model is an important tool for investors because it provides a framework for making investment decisions. By using the CAPM model, investors can compare the expected return of an investment to its risk and make a more informed decision about whether or not to invest. In addition, the CAPM model is also used by companies when making investment decisions. Companies will use the model to evaluate the cost of capital, which is the return that investors expect to earn on their investments. That's all for today. Please remember to like and subscribe if you found the video helpful.